It's been a mosaic, and you've got the S&P down about 12% from its peak. The Russell's down about 16%. And certainly what's going on at the Fed, the concern about trade and tariffs, the concern about the fiscal policy implications of the blue wave next week, all of those things I think have contributed to a pretty significant downturn here in the market over the last couple of months. Now, Andrew's not here, so I'll throw him under the bus. He gave me a hard time when I was here over the summer. Becky was here. We took some chips off the table at the end of June, and he was saying, why are you doing that? Market's just going to keep going straight up. And he said, look, we think there's the potential for an air pocket here during the third quarter, and we want to put the money back to work at better prices. We think there's going to be a nice rally at the end of the year. October is the month that bear markets go to die. I think that we are going through that bottoming process right now. We're hitting our signposts. Earnings, as you talked about, coming in better than expected. We hit our 3.5% GDP number on Friday. We think we're going to get a good jobs number this coming Friday, and we think the election next week is going to be less bad than the market fears. All of that, we think, will contribute to a nice year-end rally.
I forgot it. I mean, we just had a jobs number that was just right, remember?
That's what happens the older we get.
Okay. Charles, you agree with Phil? You also think it's somewhat the Fed is part of the if something's ailing the market, that's where you point?
Powell created what I call a first-year mistake when he said we could go neutral or beyond neutral. You throw on top of that his comment that we're in extraordinary times. Everything we see looks good. We don't see a problem. And the problem is the markets are looking at the exact same data, and they see lots to be concerned about because they're discounting the future 6 months to a year ahead, and they see trade issues, decelerating economic growth in China and Eurozone. We saw PMIs last week from Europe that were poor. We had a PMI manufacturing report last night from China that was poor, with export orders the weakest since early 2016. We had the United States GDP, which came out. You take out inventory, and it was up only 1.4%. Business investment was up spot 8, down from 11% in Q1. Things are slowing down. But Powell says things look great. And markets are, the nonchalance of that is disconcerting to many investors, and they get troubled by that. At the same time, the Fed is undertaking a unconventional tightening policy by not only raising rates in a traditional way, but also normalizing the balance sheet. Now, because the balance sheet was expanded, the Fed's balance sheet, to $4.5 trillion from $920 billion in an unprecedented fashion, reversing it and closing that procedure out is a grand experiment. And caution and handling it delicately probably would make a lot of sense given the economic uncertainty that's out there. But when he talks with confidence and conviction and changes the Fed's statement to reflect that conviction, it unnerves market participants.